All right, in this lesson, we're going to walk you through a sales transaction example. We're actually going to be looking at sales. We're going to look at sales returns, and then we're going to look at sales allowances and how those journal entries are going to look like. And at the very end, we're going to get to the bottom of what our net sales are. So if you are ready, let's take a look at this example. Here is the example prompt. It says company A has the following transactions, and we could go through all of them, but we are going to tackle them each individually. So I'm going to go ahead and skip that and go straight to the question. At the very bottom, it says prepare the journal entries for each date. Then prepare a schedule of total profits earned on the September 5th sale after considering the refunds, discounts, and allowances. So we're going to look at everything as a whole at the very end to kind of get what our gross profit is. So we're going to look at each individual one first, and then we'll get to the very end. So let's go ahead and look at the first one. The first one says that on September 5th, we sold $120,000 worth of inventory to a customer for a total sales amount of $250,000. The terms of the sales was $210 net 30. So let's breaking this down. We are selling $250,000 worth of goods to our customers, but it only costs us $120,000 to acquire. In addition, we sold them on account on terms. Now, we've been talking about how if you see on account, that would basically mean that we bought it, someone purchased it from us with an accounts receivable. Basically, they're going to owe us the money rather than paying us cash up front. Now, in this problem here, we don't have the word on account, but we also don't assume that this was paid in cash. We assume that it was paid with an IOU because the terms here, 210 net 30 is presented. So if you see 210 net 30 or the sales terms, then you can safely assume that it was sold on credit rather than on cash. Okay, so the two things that we're going to need to do here is we're going to need to do two journal entries, one for the sale of the good and one for the cost of the good. So if we start with the sale of the good, we sold, how much did we sell our merchandise for? Well, we sold it for $250,000. So when we sell goods, that is considered revenue. So revenue is going to increase because we sold $250,000. In return, we would normally get cash, but we know we're not getting cash. So instead, we are getting an accounts receivable. So we are going to increase the accounts receivable. An increase of an accounts receivable, which happens to be an asset, would be a debit. So we're going to debit accounts receivable for $250,000. And then we're going to credit what brought us that sale in this case, or what brought us that $250,000 of an accounts receivable. That would be the sale. So we're going to credit sales revenue for $250,000. So that is the journal entry for the sale. Now we need to look at the journal entry for the cost of the item. Well, the cost that we incurred according to this problem was $120,000. $120,000 would be the expense. So we're going to debit an expense for the $120,000. And we're going to take that cost out of inventory, which it's currently stored in. So to do that, we're going to debit our expense, credit our assets. So we're going to debit our cost of goods sold for $120,000, and we're going to credit inventory for $120,000. So we're taking it out of the inventory bucket and we're moving it to the cost of goods sold since we did sell the product to our customers. So that is our sales transaction on September 5th. We made a sale, so we have to do two sets of entries. Moving on to September 7th. September 7th, $12,000 of inventory was returned to company A that were sold to the company on September 5th's customer for $25,000. So what this basically is saying is that we received back $25,000 of merchandise that originally cost us $12,000. So that customer didn't want it. So we're going to accept that return. We need to reverse all of the entries that we did, but we're not going to reverse it for the full amount. The customer only returned $25,000 of the $250, not $250,000. So we're only going to reverse $25,000 worth of merchandise rather than the $250 that we just did in the last entry. So the first thing that we need to do is we need to refund we need to do the refund of the goods return. So the refund of the goods return will be the amount that we're refunding to our customer. Well, we are going to refund to them $25,000, but since they haven't paid us yet, we're not going to refund cash. We're just going to refund or credit their accounts receivable, and then we are going to reduce our sales because the sales actually didn't happen at the end of the day because they were returned to us. To do that, we are going to debit sales revenue and we're going to credit the accounts receivable. That reverses what we just did in the last lesson. So debit sales revenue for $25,000 and credit accounts receivable for $25,000. So once we have that, then we need to return the goods to inventory. So we're going to take them out of the cost of goods sold and move it back to inventory. To do that, we're going to reverse the entry that we did in the last part there. So we are going to debit inventory. So we're going to add inventory. And in this case, the inventory originally, the goods originally cost us $12,000. So we're going to return $12,000 to our inventory account. So we're going to debit $12,000 to inventory. And then we're going to reduce our cost of goods sold by $12,000. We're reducing it because we didn't really incur that expense now that we have our product back. So when we return goods, we have two sets of entries as well, reversing everything that we did in the previous sets of entries. Now, moving on to transaction number 3 on September 9th. The September 5th customer alerted Company A of a defect in some of the product's packaging. Company A negotiated an allowance of $12,000 for damaged packages, and the customer decided to keep the product. So in this case here, no products being returned to us, so therefore we don't have to worry about returning goods to inventory, but we are going to give an allowance to the customer because they have agreed to keep it rather than return it to us. That allowance basically means is that what we did have in revenue needs to come down by this amount. Since we technically didn't sell it for that amount, we're selling it for a lesser amount because we're giving the allowance. And we also need to reduce how much they owe us because they still haven't paid us yet. Otherwise, we would give them cash back. So in this case here, we have to reduce our sales revenues by this $12,000 because we didn't really sell it for that higher price. So we're going to debit sales revenues of $12,000. And we're going to credit accounts receivable for $12,000. So that's what our entry looked like for the allowance that we are giving our customer. Now, obviously, it's time for the customer to pay us. So on September 12th, the customer paid the remaining balance within the credit terms. Terms were 210 net 30. So the question already tells us that they paid back within the credit terms. We can also look at the date. So their original purchase date was on September 5th. They paid us on September 12th. That's about 7 days. So if it's 7 days, it's within that 10-day period. So they get 2% off of what they owe us. Well, the first thing that we got to figure out is how much do they really owe us? Well, if you look here, I've got a T account for the accounts receivable. Transaction number 1, we debited the accounts receivable by $250,000 for the sale. We also have a credit in transaction 2 to the accounts receivable for $25,000. That is the return of the inventory that came back to us. So we reduced their accounts receivable by $25,000. And then in addition, there was $12,000 that we gave them as credit because of a sales allowance or purchase allowance. So we're giving them an allowance because we don't want them to return it to us. We'd rather them keep it, and we'll just go ahead and give them a credit of $12,000. So we have a T account here that expresses that. If we go ahead and do the math, bigger side minus smaller side equals the bigger side, you're going to get $213,000 on the debit side. That would basically mean that the customer owes us $213,000. Now, to calculate the discount, we'll take how much they owe us net, in this case $213,000, and we're going to multiply it by the 2%. So $213,000 times 2% gives us a discount of $4,260. So this customer would get to pay us $4,260 less than they actually owe us because they're paying within the 10-day period. So they qualify for the 2% sales discount. So to do the math here, we could take 213,000 subtracting 4,260, and the total amount of cash that we will receive is $208,740. So now that we have kind of the components of numbers here, now it's time to do the journal entry. So we know that we received cash. In this case, we received cash in the amount of $208,740. So we're going to debit cash for $208,740. And then we also know that we have to extinguish all of their debt. So if we know we need to extinguish all of their debt, then we're going to get rid of the accounts receivable. To get rid of the accounts receivable, we have to basically make the accounts receivable for that customer a zero. So to do that, it's already at a debit balance. To make it zero, we need to credit that balance for the full amount. So to do that, we will credit accounts receivable in the amount of $213,000. So now we have a plug or a hole. That hole is going to reduce the revenues because technically we didn't earn those revenues because we gave them a discount. So we are going to debit sales revenues, further reducing our sales amount in the amount of $4,260. That plug there basically will get us to the $213,000 on the debit side. So when the customer pays, they're going to give us a check for $208,740. We're going to basically waive off $4,260 as a discount for them paying early, and then we will extinguish the receivables in full amount. If we didn't do it in the full amount, the customer would still owe us $4,260, and based on how we set the sales terms, they shouldn't owe us anything after all. So we have to reduce the accounts receivable by the full amount that they were supposed to owe us, net after returns and allowances. And then the hole that we would have would basically get plugged with a reduction to sales revenues because basically we're selling the goods even less than we thought we were going to sell it in the first place. So that is transaction number 4 for September 12th. Now, the last thing that we need to do here is we need to figure out what our gross profit is after all of these deductions. Now, I don't have all the numbers in front of you right now, but if you are writing notes, you should have them in front of you. I do have it in front of me as well. And so we're going to go from top to bottom and show you kind of what we're doing here to get to the net gross sales and then what our gross profit is. So our gross profit is net sales minus cost of goods sold. That's kind of where we are. All right. So if we start with sales revenues gross, we started with $250,000 of sales. So that's what our original sales was. Then our customer returned to us $25,000. So I need to subtract $25,000 from that $250,000 to kind of get to the net sales. Then from there, we gave them an allowance of $12,000. And then we gave them a sales discount in the last entry of $4,260 for paying early. So our net sales for this customer was $208,740. Now we got to figure out cost of goods sold. So we can go back to the other entries and look at our cost of goods sold. We actually had 2 entries that dealt with cost of goods sold. The first entry was the initial cost of goods sold. That initial cost of goods sold was $120,000. Then in the next problem, the customer returned some inventory to us. So we reduced cost of goods sold, in this case, by $12,000. So our net cost of goods sold is going to be $108,000. So biggest mistake students will make here is they forgot that the customer returned that inventory to them, and as such doesn't take into account that cost of goods sold is now being lowered because we didn't really sell it, which means we didn't really incur the expense since we have the goods back in our possession. So cost of goods sold goes down to $108,000. So if we put that in here, $208,000 minus $108,000 cost of goods sold gives us a net profit of $100,740. So as you can see, it is a long process to get to the very end here. But for this company, they are profitable, and we know that they're profitable because, well, at least we know that they're gross profitable. We know that because their revenues exceeded, after net, exceeded their cost of goods sold. Now, after this point, we have to subtract operating expenses like utility expenses, employee and salary expenses, insurance expenses, maybe building rent. There are so many other expenses that go after this that we'd have to cover with this profit. And again, this is only one sale, so this company might have many sales to be able to cover all of those other expenses. But that's how we get to gross profit, and that number is super important because that's telling us that after we've sold the product that we usually sell, we are making a profit, and then the rest of that goes to operating expenses as well as to the bottom line net profit. So that is a look at a complete look of a sales transaction example, everything from the start of a sale to a return and then allowances and then that sales discount that we talked about in the last couple of lessons. So hope you enjoyed this walkthrough of this example, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or clicking the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.